Imagine trying to make sense of a market that moves lightning fast, where the ground beneath your feet seems to constantly shift.
Yeah.
Prices aren't just inching along. They're jumping, often dozens of ticks in mere seconds. This isn't your slow, steady market. This is the intense, high-stakes world of thin markets.
That's right. We're talking about markets like gold, crude oil, or natural gas, especially during active trading hours or, around significant events.
Right.
They behave fundamentally differently from the thicker, more liquid markets maybe traders are used to. Understanding this difference is step one.
Exactly. And our mission today, our deep dive into the source material you have, is to really unpack what makes these markets tick, why they're so uniquely challenging to read using traditional methods, and what specific order flow signals and tools, particularly those focused on speed and identifying larger participants, can actually give you an edge when everything is happening in the blink of an eye.
Yeah, that's the goal.
We're pulling insights directly from a detailed exploration of strategies and tools discussed in a specific audio recording, focusing on real-world application. Our goal is to cut through the noise and show you what truly matters when price is moving faster than you can possibly process all the incoming data.
It's really about shifting your focus, away from trying to analyze every single micro movement on the ladder,
Right.
to identifying the critical clues left behind by the more powerful forces at play.
Yeah.
It requires a different mindset and definitely different tools.
So let's start right there. What is a thin market fundamentally, and how does it differ in its core mechanics from the thick markets that are often the subject of trading discussions?
Well, the name thin itself is probably the most descriptive clue.
Yeah.
The primary distinction lies in the level of liquidity.
Okay.
Think about thick markets first, like U.S. Treasuries, often referred to as boons, or even major indices like the S&P 500 futures, commonly known as ES.
Yeah, the big ones.
Right. These markets have enormous amounts of buy and sell limit orders stacked up on the trading ladder, or what's sometimes called the dome, or depth of market. You'll see large numbers, hundreds, sometimes thousands of contracts sitting there at various price levels, particularly near the best bid and offer.
Right.
These are often referred to as fat figures because they represent substantial walls of resting orders.
Right, like a really solid barrier at each price point that price has to chew through.
Precisely.
Yeah.
Now, flip that completely for a thin market. The first defining characteristic is that significantly low level of liquidity.
Okay.
When you look at the ladder in markets like gold or natural gas, which our sort highlights as having the most thin ladder,
Yeah.
you just won't see those fat figures.
Not at all.
Well, according to the source material, near the inside bid and offer the best prices currently available, you might see incredibly low numbers, perhaps just 3, 5, sometimes even a single one contract resting there.
Wow. Just one.
Yeah, sometimes. As you move further away from the inside price, you might see slightly higher numbers, maybe 10, 15, maybe 20. Occasionally, perhaps 50 contracts might be visible at a price level slightly further out, but that's less common, especially during, calmer periods.
Wow. So comparing single-digit contracts or dozens to potentially hundreds or thousands in a thick market,
Right.
that's a dramatic difference in the immediate supply and demand resting there.
It's huge.
What's the fundamental implication of having such low numbers of resting orders on the ladder?
That low liquidity is absolutely fundamental to understanding why these markets behave the way they do. It means it takes significantly less capital, fewer market orders, and ultimately less overall pressure to push the price from one level to the next, or even to move it substantially.
Ah, okay.
Large participants, often called large players or institutional traders, find it much, much easier to move the market according to their own agenda.
Right.
There's simply less resistance in the form of limit orders to absorb their buying or selling pressure compared to a thicker market. They can step in with relatively smaller size and have a disproportionate impact on price movement.
Okay, so low liquidity means less friction, making them easier for big players to manipulate or move directionally. What else defines them?
Well, the second characteristic directly stems from that low friction. They exhibit faster and larger price moves.
You mentioned lightning speed earlier.
Yeah, and that's not an exaggeration. Price doesn't typically grind tick by tick, inching along slowly like you might see in a very thick market where every tick has a battle of hundreds of contracts. Instead, you see what our source calls bursts of order flow. These are rapid, aggressive pushes where a relatively small amount of market orders can push the price 10 to 20 ticks very rapidly during active phases of trading.
10 to 20 ticks? Just like that?
Just like that. And during major news events, Significant economic data releases or large liquidation events, like stop runs, which we'll definitely get into, those bursts can be even more extreme, pushing price 50 to even 100 ticks in a very short time frame, sometimes measured in seconds.
That's a huge difference compared to, say, the S&P 500 futures, where a typical move in an active phase might be just 2 or 3 ticks before it consolidates, finds some resistance, or pulls back. The magnitude and speed are just on a different scale.
Exactly. The pace and magnitude of individual price movements are vastly amplified in thin markets. This is particularly true for markets like gold or natural gas, as mentioned, due to their extremely thin ladders, but it also applies strongly to crude oil.
Okay, so crude too.
Yeah. While crude oil might be slightly less thin than gold or gas, it's still described as a very active market with similar rapid, large moves compared to indices or bonds.
So faster, bigger individual moves. And the third characteristic completes this picture of high volatility.
The third is a larger size of rotation, or legs. You can think of rotations or legs as the swing highs and swing lows you see forming the zigzag patterns on a price chart.
The swings.
Right, the overall price swings or moves between points of consolidation or reversal. In thin markets like crude or gold, these swings are typically much larger in terms of price points, often 30 to 50 ticks.
Again, significantly larger than the smaller, tighter 8 to 12 tick rotations you might expect on something like ES.
Right, so you have less resistance on the ladder due to low liquidity,
Sure.
leading to faster, larger individual price jumps.
Okay.
And crucially, those rapid jumps aggregate into larger overall swings or rotations on the chart.
Got it.
These three characteristics, low liquidity, faster, larger individual moves, and larger rotation sizes, fundamentally change how these markets behave and how they must be approached. They require a completely different perspective on trading and, critically, on reading order flow compared to more traditional, thicker markets. Understanding these inherent differences is the absolute prerequisite for developing a successful strategy in this environment.
Okay, that contrast is incredibly helpful. It paints a clear and compelling picture of why these markets demand a different strategy. You can't just apply methods built for high-friction environments to a low-friction one. So let's talk about the challenge this creates for a trader trying to read order flow in real time.
Yeah. That's the core difficulty that trips many traders up. As we've established, because liquidity is low, it's much, much easier to move market for large participants.
Right, the manipulation aspect.
Exactly. This isn't just theoretical. It has a crucial practical implication. What you see on the ladder in terms of exact numbers, the number of contracts resting at each price, might not be a pure reflection of genuine broad market sentiment. It could be strategic placement by a large player, intentional small bursts of market orders to probe levels, or even attempts at manipulation to trap other participants.
So you can't just trust the numbers you see on the dome as a reliable indicator of supply and demand pressure.
Not in the same way you might in a very thick market. And even if the numbers were pure, the sheer speed of the moves and the rapid changes happening on the ladder make detailed analysis incredibly difficult to perform in real time and derive actionable insights.
Right, the speed kills the analysis.
Totally. Think about the contrast again. In a very thick market, like bonds, boons, price might sit at the same tick for 5 minutes or longer.
5 minutes? Wow.
Yeah. You have ample time to leisurely observe the numbers changing, watch limit orders being added and removed, see trades print on time and sales, and analyze the shifting depth across the entire ladder. You can comfortably process and analyze that information.
That seems almost like watching paint dry compared to what you're describing for thin markets.
It absolutely is. In thin markets, you do still see those things happening. Orders appearing and disappearing, trades printing rapidly. But it happens with such speed and intensity that it's almost incomprehensible to notice and analyze in time.
Yeah.
For a human brain trying to track it all simultaneously.
Okay.
Your ability to process the rapid changes across the entire ladder, calculate imbalances in your head, and derive meaningful real-time insights from the exact numbers simply gets overwhelmed.
And compounding that, even if you could process it quickly enough, the ease of manipulation means that information based on those exact numerical changes, the precise count of bids and offers at specific levels, matters very little on its own.
Exactly. A large player can throw in a large spoof order that disappears instantly or place a small burst of market orders that isn't representative of their true position size.
So it's noisy and potentially misleading.
Precisely. This overwhelming speed and the potential for misleading information on the ladder force a fundamental shift in focus. You stop trying to analyze the precise micro movements, the exact numbers, and the individual order flow events happening tick by tick on the ladder.
Okay, so what do you focus on instead?
Instead, your attention must shift to identifying the market's overall tendency. Is it biased up or down? And even more importantly, you need to be able to spot when that tendency is changing.
Right, the shift.
But again, if you're fixated on reading every single number on the dome, you'll likely miss the bigger picture of the overall flow and the crucial shifts in sentiment. The challenge is finding signals that cut through this noise and speed.
Okay, so the traditional approach to reading the ladder, focusing on specific numbers and individual orders, is less effective or even counterproductive. What specific order flow signals do matter then? What should a trader in a thin market be looking for that actually provides reliable information?
That's the critical question, isn't it? The source highlights that some classic order flow signals that are quite popular and effective in other markets are either less useful or require significant adjustment and, frankly, a high degree of skepticism in thin markets.
Which ones are we talking about?
Things like iceberg orders or divergences.
Ah, the hidden orders where a large order is broken into smaller, visible pieces, iceberg orders, and the signs of weakening momentum where price makes a new high-low, but volume or delta doesn't confirm divergences.
That's them.
You can still see these, but they're not as reliable as signals.
That's right. They do appear in thin markets, just like they do elsewhere, but often on a much smaller scale that makes them hard to use for a meaningful, actionable signal. The source says they're everywhere, on a small level, constantly flickering, which makes them hard to distinguish from random noise.
Okay.
If you try to configure your indicators or tools to pick them up reliably, you'll find you need much smaller numbers compared to tuning them for something like ES.
Smaller numbers, like how small?
Well, the source suggests trying configurations like maybe a 50 contracts filter for iceberg and 50 for divergence on gold, just as a potential starting point. But it emphasizes that these numbers are vastly smaller than you'd use in a thick market.
And what happens when you try to tune indicators like that for thin markets? Does it work?
Usually not very well. You'll likely find you get too much of them or too little or none of them. They're either constantly firing on small, insignificant events, leading to analysis paralysis or false signals, or you tune them too tightly and miss the bigger, potentially relevant ones.
So they're tricky to rely on.
Yeah. The conclusion drawn from the source material is that these classic small-scale signals are generally hard to use reliably in thin markets and only seem relevant when really big things appear. But at that point, you might see those big things happening through other, more robust means anyway, making the specific signal less critical.
Okay, so we need to look for signals that are less susceptible to the speed and manipulation challenges. What are the most important order flow signals that do matter in this environment?
Right. The source points to 3 key areas that provide more reliable clues about large participant activity and market conviction. The first is analyzing the actual market orders that have traded at specific price levels, particularly after a move has occurred.
So not the limit orders sitting there passively, but the aggression, the volume that hit the bid or lifted the offer, the orders that actually executed against those resting limits.
Precisely. This involves looking at the aggregated volume and pressure that traded at specific price levels, often observed on your time and sales display or a footprint chart.
Okay.
After a swing high or swing low has formed, or after price has reacted to a significant level.
So you look back at what happened at the level.
Yeah. The source's methodology involves looking back at the data generated at that specific price level after the fact to understand the battle that occurred there.
Interesting.
A practical tip mentioned to make this analysis cleaner is to flash or clear the historical data on your display just before the price reaches a level you're intently watching.
Oh, okay. Why do that?
Well, this way, you only see the data generated at and immediately around that specific level as the action happens, avoiding confusion from previous trading in the same area.
That makes sense. You want to isolate the order flow that occurred right now at that critical price, not mix it with historical data. So what would you be looking for in this executed order flow analysis at a key level?
Okay, so an example given is if price goes up to a previous swing high, perhaps retesting it and then pulls back.
Right.
You would then look at the aggregated data at that swing high on your time and sales or footprint. If you see a significant number of market buy orders, aggressive orders that hit the ask or traded against sell limits occurred right at or slightly above that peak, but the price did not manage to move significantly higher or was quickly rejected, that's a good clue that someone is protecting this high.
Absorption.
Exactly. It suggests that substantial selling pressure, or large limit orders, were present at that level, absorbing aggressive buying pressure. This implies the level is important. Large players stepped in there. It might also suggest that stop orders or other interests are resting just above that level, which could become a target if the selling pressure is eventually overcome.
Okay, so looking at the battle that already happened at a key level gives you a retrospective clue about its importance and potential future reaction. It confirms that this level is significant and attracts large participant interaction.
Exactly. This helps you identify prices that are important because significant order flow activity occurred there, whether it was absorption or initiation of a move. And the strategy revolves around trading around these identified important prices.
Got it. What's the second most important signal that cuts through the thin market noise?
This one is more about anticipating the move. Huge imbalances on the ladder, specifically the total number of contracts stacked on the bid side versus the total on the offer side, extending out several ticks from the inside price.
Total bids versus total offers.
Okay. The source describes this as one of the two most important indications that I use when the move starts, particularly when combined with the right chart context.
Looking at the whole stack of limit orders on each side on the dome, not just the closest ones?
Yes, precisely. On your time and sales display or Superdome, you look at the total number of contracts stacked up on the bid side versus the total on the offer side across the visible depth.
And what kind of imbalance are we talking about?
Well, the source gives a specific striking example, seeing a total of 50 contracts on the bid side and 200 on the offer side.
Okay, 50 versus 200.
That's a 4-to-1 difference.
Yeah.
This is described as a strong signal that something is going on, that there's a significant imbalance in the resting limit orders, and the market is most likely preparing to make a move up if this imbalance is seen as price approaches a key resistance level.
Wait, that still sounds counterintuitive, as we touched on earlier.
Yeah.
If there are way more sell limit orders, offers, stacked up than buy limit orders, bids, wouldn't that mathematically suggest the market is more likely to go down hitting those bids because there's more sell supply waiting?
Yeah, it feels backwards at first, doesn't it? This is where the nuance comes in, and it's a critical distinction. The source addresses this as representing the fight between buyers and sellers playing out visually on the ladder.
The fight. Okay.
Seeing a large stack of offers when anticipating or seeing signs of a move up often represents the selling side trying to protect the market from moving against them.
Ah, protect.
They're trying to provide liquidity offering to sell at various price levels above the current price, hoping to cap the upward move or get filled on short positions without the price rising too fast. It's like a resistance zone they are trying to defend with a large number of limit orders. If the market still looks like it's preparing to move up, or aggressive buying is hitting the ask despite that large stack of offers, it indicates strong underlying buying interest that is likely to absorb those orders. It's a sign that buyers might be overcoming significant resistance.
Ah, so the imbalance, when it's heavily skewed with limit orders opposing the expected or unfolding move, isn't necessarily where price will go because of the limits, but rather a visual representation of the resistance the market orders are battling against.
Exactly.
And the size of the limit stack tells you about the strength of that resistance or the significance of the level being defended.
Precisely. It's about seeing the battlefield and understanding the forces lined up on either side. And here's the crucial context from the source, reiterated for emphasis. Remember, huge imbalances on the ladder are important signs, but only at the right places. It does not matter in the middle of nowhere.
The right places, meaning those important price levels we just discussed, like previous swing highs, swing lows, or consolidation zones identified on the chart.
It's exactly right. These are levels where large market participants are likely to be active because they represent significant turning points or areas of prior conflict.
Okay.
For example, if price is retesting a swing high, maybe forming a double top, if at that level you see a big imbalance, say a 3 or 4-to-1 ratio with many more offers stacked above the price than bids below it, but the market is still grinding or pushing up towards that level, that's a sign of huge buying pressure absorbing those limit orders.
Wow.
It confirms that the level is significant and that one side, the buyers in this case, are aggressively trying to push through the resistance.
So the imbalance at a key level confirms the intensity of the battle and gives a visual cue about the likelihood of a breakthrough or rejection based on who seems to be winning the absorption game.
Yes, it's a powerful visual cue when viewed at the right location. And the size of the limit order stacking also gives you a clue about where the next move will go, and how important it is.
How so?
Well, if at a potential swing high, the ladder is almost balanced, say only a 20% or 50% imbalance between offers and bids, it suggests there's very little protection or fence going on at that level. The source argues this means the level doesn't really matter to larger participants, and it's probably a poor place to look for a significant trade setup based on a major order flow battle. You want to see large fences being defended for the level to be truly important.
Okay, so huge imbalances, but only at critical price levels identified by chart structure. That's a powerful combination.
Got it. What's the third key signal that helps in these fast markets?
The third is the reconstructor tape. This is described as a measure indicator that the source loves and considers far more superior than any standard tools, like just watching the raw time in sales or volume by price.
Reconstructor tape, how does it provide more clarity than just the time and sales feed?
Well, it attempts to put together individual orders back into original large orders.
Ah, okay, like
Yeah.
piecing together a puzzle. Sort of, yeah. The key insight here is understanding how large players operate. If an institution wants to buy or sell a very large quantity, say 500 contracts,
Yeah.
they typically cannot just hit the market with a single 500 lot order without causing massive slippage and instantly moving the price against them.
Right, that makes sense.
So they break that large order up into many smaller pieces,
Yeah.
maybe 50 contracts here, 20 there, hundreds somewhere else, often executed over time or across different venues.
Okay.
The raw time and sales just shows you these individual small pieces. The reconstructor tape uses algorithms to try and identify when multiple smaller market orders executed very close together in time or price are likely part of a single larger parent order.
I see.
By aggregating these back, it helps you see the activity of large players more clearly, cutting through the noise of all the small retail orders and the split tactics of institutions.
So it helps you cut through the noise of tiny trades and see what the big money is actually doing in terms of aggressive buying or selling.
That's exactly the idea, and why it's considered superior. It helps you identify the conviction of large players.
How do you set it up?
You configure it with specific filter numbers for what constitutes a large order to aggregate, and these numbers depend on the market and how liquid this specific session is.
Okay.
The source suggests examples like setting the threshold at 10 contracts or more for gold, or maybe 30 or more for oil during thinner sessions, and perhaps doubling or tripling that for highly liquid sessions.
Yeah.
You can also set alerts for when an aggregated large order above a certain size, maybe 20 or 50 contracts, prints.
And what are you looking for on this reconstructor tape as a signal? What tells you something important?
Okay, so if you're looking for confirmation for a die signal, you want to see a lot of buy market orders, large market orders appearing.
The big ones.
Yeah. The source refers to these visually as large green block orders appearing on the tape display. Green indicating market buys hitting the ask with size, aggregated from smaller pieces.
Green blocks meaning aggressive, aggregated market buys hitting the offer side.
Exactly.
Hitting the ask with aggregated size, an example given is if price makes a double top, pulls back slightly, but then you start seeing lots of these large green block orders on the reconstructor tape, and price begins racing up towards that previous high again, potentially setting up a triple top.
Right.
This activity on the tape is a big sign of a breakout is going to happen because you are seeing clear, large participation.
Yeah.
Big players are actively pushing the market higher towards that resistance level, confirming the momentum and conviction behind the move.
It confirms that the force behind the move is significant, coming from participants who can move the market. What if you don't see that large participation on the tape? What does that mean?
Well, if price is slowly crawling up towards a level with just a mix of orders and nothing really big, meaning you're not seeing those large aggregated blocks appearing on the reconstructor tape, that's a sign of warning. It suggests the move lacks conviction from large players. It might just be smaller participants or algorithms pushing it.
In that scenario, you probably don't want to trade this market in that direction because the institutional support isn't there to sustain a breakthrough or a large move.
So the reconstructor tape helps you quickly assess if the move or the activity at a level has big money participation behind it, which is crucial confirmation for trading in thin, potentially manipulated markets. It helps you see through the noise of individual small trades.
That's its core value, really. It gives you a quick, visual, and often auditory cue with alerts about the presence, direction, and intensity of large order flow. which is far more meaningful than tracking individual small prints.
Okay, so we have analyzing executed market orders at key levels after the fact to confirm their importance.
Yep.
Looking for huge ladder imbalances, specifically at those levels as price approaches to gauge resistance and battle intensity. And using the reconstructor tape in real time to confirm large player participation and conviction. These are our key order flow signals. But the source also brings in another crucial element, one that provides the essential context for these order flow tools: charts and price action.
Absolutely. You can't forget the chart. While order flow tools are vital, especially in thin markets where the ladder is too fast and thin to read traditionally, they aren't sufficient on their own.
They're not enough.
No. You cannot ignore the charts. They provide the map for where to apply your order flow analysis.
Why are charts required in thin markets, especially if your focus is so heavily on order flow dynamics? Couldn't you trade just from the ladder and volume profile in slower markets?
Yeah, the source acknowledges that in slower, very sick markets like bonds, it might be possible for some traders to operate primarily from the ladder and volume profile because things move slowly enough for you to process the bid-ask depth, volume profile shapes, and VWAP comfortably.
You have time.
Yeah, you have time to analyze the detailed structure of the market at a single price level. But in thin markets, precisely because things move so fast and you can't always comprehend the rapid changes on the ladder in time, you absolutely need to use chart.
Okay.
The ladder is too fleeting for reliable decision-making on its own.
It's too fast to read the nuance on the dome, so you need the chart for the structural context and slower feedback.
Exactly. The source uses a great, memorable analogy. Price action is the footsteps of order flow.
Footsteps of order flow. I like that.
Yeah. It's the result of the order flow battle that has already occurred over time. The chart that doesn't show you the live, chaotic battle on the dome, but it shows you where it's been, how it was reacting. It's the historical footprint of the buying and selling pressure that molded the price over minutes or hours.
So the chart isn't for traditional technical analysis like calculating EMAs, drawing trend lines, or identifying classical candlestick patterns, but for reading the story of the price action itself, where the major battles happen, where price was stopped.
Precisely. The source explicitly states that this isn't about using classical lagging indicators like EMAs, or drawing geometric shapes like triangles, or relying solely on standard candlestick patterns like engulfing bars in isolation.
Okay.
While acknowledging that others use them, and potentially knowing where their stops might be placed based on those indicators, can be useful for finding areas of potential order flow surges or liquidity pools.
Right, finding the stops.
The focus here is on reading market sentiment and structure without those indicators, by looking at the raw price history.
What specifically should we be looking for on the chart then, if not indicators or complex patterns? What are the key things?
The essential elements you're looking for on the chart are the overall market sentiment or bias for the session, where price has been and the path it took, crucially where price was rejected forcefully, where price consolidated, indicating periods of balance or indecision, and where price could not sustain its movement for long, leading to rapid reversals.
So the turning points, the pauses.
Exactly. These are the areas where significant order flow battles occurred in the past and are likely to occur again.
And the strategy is to focus your attention only on these areas and forget about trying to trade in the mid-range.
Yes. The source strongly advises concentrating your attention and focusing your trading efforts only on where the action is. Specifically, those areas of rejection, consolidation, and swing high-slows.
Right.
Trading in the middle of a wide range, far from key support or resistance levels where previous battles defined the boundaries, is considered low probability. That's the middle of nowhere, where ladder imbalance doesn't matter.
That makes perfect sense. You want to be positioned where the significant forces are likely to engage, not in the quiet zone between battles.
Yeah.
And how do you handle the potential confusion of chart patterns, the fractal nature of markets with the swings inside swings on different time frames? That can get complicated.
Yeah, it really can. The source offers a practical simplification specifically for day traders operating in these fast markets.
Yeah.
It's so much easier and clearer to concentrate only on the current session's price action.
Just today's action.
Yeah. Focus on its overall sentiment, its swing highs, swing lows, rejections, and absorptions as defined within that session. This eliminates the complexity and potential confusion of conflicting signals that can arise from trying to reconcile patterns and levels across multiple time frames simultaneously.
Okay.
If you just look at the current sessions chart, you have a clear picture of the recent sentiment and the key levels defined by price action within that specific trading period. Much simpler.
So the chart is your essential map, showing you the key battlegrounds, the swing highs, swing lows, areas of rejection and consolidation within the context of the current session's price action.
Right.
Then you use your fast-acting order flow tools, the ladder imbalance, the reconstructor tape, the analysis of executed volume to read the battle at those specific locations, confirming the presence and conviction of large players at the moment of truth.
That's the synthesis of the approach. Price action tells you where the high probability levels and zones are located. Order flow tells you what's happening there in terms of large participant activity and pressure right now.
Oh, this brings us to the practical application. Let's look at the examples the source provides to see how these concepts come together in actual trading attempts. It's important to remember these are shared for educational purposes, illustrating how you can approach trading these fast, thin markets using the described order flow methodology, not as guaranteed trade setups.
Right, definitely educational.
Yeah.
The first example discussed is a crude oil trade attempting to trade a double top break, specifically anticipating a stop hunt above a key level.
A double top break, meaning price revisited a previous significant high, and the trade was based on the expectation that aggressive buying would break through it, potentially triggering stop orders resting there.
Yes, exactly. A previous swing high was identified on the chart as significant, meaning it was a clear turning point where price had previously been rejected.
Okay.
This implies that traders who had gone short during the previous move down would very likely have placed their protective stop-loss orders just above that high to limit their risk.
Makes sense.
Additionally, reversal traders looking to go long might have placed buy-stop orders above it, anticipating a breakout. So you get this cluster.
A cluster of orders?
Yeah, a cluster of potential buy orders, both stop losses from shorts and buy stops from longs resting just above the significant high, waiting to be triggered if price rises.
Okay, so the chart identified the right place, that significant swing high where a pool of stop orders was likely waiting. What specific order flow signals confirm the idea of trading a break above this level?
Okay, so as price approached that level, the source observed several reinforcing clues. First, the chart showed price approaching with really nice momentum push. It wasn't slowly crawling, it was moving with conviction. Second, and critically, on the reconstructor tape, they saw really large orders, green orders, buy orders appearing.
The green block.
The green blocks. This confirmed that large aggressive buyers were active and pushing into the overhead resistance offered by the previous high.
Large players confirming their intent by aggressively buying into the resistance level. What about the ladder imbalance at that level? Was that significant?
There was some imbalance observed on the ladder or dome as price approached. The source noted it wasn't the absolute largest imbalance you might ever see, described as not so big difference, but it was bigger than a balanced book.
Okay.
Quantified as almost 2-to-1 difference between offers and bids, with offers being the dominant side.
So more offers than bids.
Yeah. For a long trade-breaking resistance, you'd ideally want to see significantly more offers, sell limits, than bids, buy limits, at that level, representing the resistance that buyers are trying to overcome, as we discussed with the strategic imbalance signal.
Right.
Even though it wasn't a massive imbalance in this specific case, it was skewed in the direction that supported the idea of buyers pressing into offers at a key resistance level.
So, momentum on the chart, confirmation of large buy orders on the reconstructor tape, and a supportive, though not extreme, imbalance on the ladder indicating resistance being challenged. Those were the core confirmations that triggered the entry.
Yes, these aligned signals indicated the presence of aggressive buying pressure, pushing into the overhead resistance at that significant swing high.
And how was the trade managed?
The trade management logic mentioned was to stay in the trade as long as imbalance will continue to be positive for our trade, meaning still significantly more offers than bids for a long position. And as long as we have those large buy orders keep coming on the tape.
Okay, watch the imbalance on the tape.
Right. If the imbalance shifted drastically or the large buy orders dried up, that would be a sign to exit.
And the outcome described in the source for this specific trade attempt,
Yeah.
Did it work?
Yes, it did. The target was filled and price was still moving beyond the initial target, indicating the breakout was successful. It was highlighted as a good example, illustrating how identifying a key level on the chart where stops are likely resting.
Uh-huh.
And then using order flow confirmation, particularly the reconstructor tape and supportive ladder imbalance, can lead to a successful trade in these fast markets. By trading alongside the large players, triggering the stop run.
It sounds like recognizing where those predictable pockets of liquidity the stop orders are likely located was key, and then order flow confirmed that the large players were initiating the push to exploit them.
That's the underlying logic, exactly. It's a combination of anticipating where other traders are vulnerable based on chart structure, classical technical analysis levels, but used here to find liquidity pools, and then waiting for the order flow tools to confirm that aggressive, likely institutional capital is stepping in to trigger those orders and move the market.
Right.
The expectation was for a rapid burst of order flow as the stops triggered, pushing the price quickly through the level.
And the risk reward seemed favorable for this setup. You weren't risking too much for the potential gain.
Yeah, the source mentioned the stop loss was placed at less than 10 ticks, while the price moved quite a lot beyond the target, suggesting a favorable potential return relative to the risk taken if the setup works out.
Okay, good risk reward. Let's look at the second example, a gold trade entry and exit strategy attempt. Gold is notorious for being extremely thin and fast, right?
Oh yeah, gold is specifically described as having the most thin ladder among the markets discussed. This example strongly emphasizes using the chart, specifically a fast time frame like a 60-second or 1-minute chart, primarily for trade management and identifying zones.
Management and zones, not entry.
Not necessarily for the exact split-second entry timing, no. The precise entry still comes from identifying a chart zone that is likely to cause order flow, like a support or resistance level, but confirmed by the fast-acting order flow tools.
Why emphasize using the chart mainly for management and zones in gold? What's different?
Because in the incredibly fast gold market, the source states you cannot really read anything on your dome for precise entry timing.
It's just too fast.
Yeah. The ladder changes too rapidly to get a reliable snapshot for an exact entry point. The reconstructor tape is highlighted as the key tool here for timing, the best you can watch, for real-time confirmation of large player action.
So, identify the potential trade zone on the chart, place a resting order, or prepare for a market order entry there, and then wait for the reconstructor tape to confirm the large player activity at that specific moment.
Exactly. The intention was to take an entry, likely with a resting limit order placed at or near a significant chart pattern or zone, and then wait for confirmation from the tape that large orders were pushing price towards that level with conviction.
Okay.
For instance, if you were planning a sell below a key low, you'd want to see price approach that level fast, and more importantly, see lots of large sell orders appearing on the reconstructor tape, confirming aggressive selling pressure was driving it down to that level.
And what about the exit in such a fast market? That seems like the hardest part once you're in. How do you manage that?
You're right, it is. The source explicitly calls exit management the biggest unknown and the hardest to pull in these fast markets, unlike entry, where you can often predefine your level and confirmation criteria.
You can't just set a target and forget it.
Not really.
Yeah.
You never know where to exit up front because the move could be just a few ticks or extend for 50 or 100 ticks. You have to react to what the market is doing after you're filled.
So how do you manage the exit if you can't pre-plan it? What are you watching for?
You constantly monitor for a big shift in market sentiment or a change in the order flow dynamics that got you into the trade.
Okay, a shift. Like what?
Well, on the tape, if you're short, you'd look for large opposing orders, large buying orders. Those green blocks again starting to come in.
Buyers stepping in.
Yeah, indicating that buyers are stepping in with size, potentially to close positions, reverse the market, or defend a level. On the dome, you look for the situation changing, specifically for new order stacking that might provide a visual clue for a potential exit point or a level where the move might stall.
So new bids or offers appearing.
Right. Alerts for large bids or offers, for example, above 20 contracts, showing up can help identify this new stacking dynamically.
There was also an interesting nuance about ladder imbalance discussed in this gold example, right? A large number of bids relative to offers, but this time suggesting a potential move down in the very short term. That seems different from the strategic imbalance we discussed earlier for breakouts.
Yes, exactly. This is an important distinction and a more advanced layer of interpreting ladder dynamics in fast markets. In the recording, they observed the specific configuration where there were significantly many more bids, 140 contracts, than offers, 50 contracts, on the ladder just before or as price was moving into a potential short zone.
140 bids versus 50 offers.
Right. The source explained that in this very short-term tactical context, this specific type of imbalance could sometimes indicate the market is likely to be pushed down.
Okay, that still needs clarification. Why would having significantly more buy limit orders, bids, below the market suggest price might go down? That seems backwards again.
It does, doesn't it? It's interpreted not as resting demand that will stop price from falling, but potentially as active market-making behavior or a tactic by larger players.
How so?
With many limit buyers sitting below the current price, market makers or others looking to get filled on long positions at better prices might aggressively sell with market orders, hitting the bids, just enough to push the price down slightly into that waiting pool of limit buy orders, the stacked bids.
Ah, they push it down to get filled cheaper.
Exactly. They do this to get their fills without having to wait passively or move the market significantly upward by buying the ask. It's a short-term push into liquidity.
Okay.
This is distinct from the strategic imbalance at a major chart level, like resistance, where a large stack of offers opposing an upward move is seen as the resistance that aggressive buyers are trying to overcome to start a larger directional move or trigger stops.
Right, the breakout signal.
Yeah, the tactical imbalance is more about a brief push into waiting limit orders.
Okay, so one is about seeing the resistance being overcome to start a breakout, strategic imbalance at a key level, and the other is about seeing liquidity waiting to be hit by aggressive short-term market orders, potentially pushing price into those limits, tactical imbalance. It's a more localized, momentary interpretation.
You got it. That's the distinction.
How did the gold trade attempt shown in the source recording play out with these signals then?
Okay, so the walkthrough describes getting filled on a short order near a level, specifically mentioning 350-352 as a potential zone.
Filled short.
After getting filled, they observed supporting stuff, specifically mentioning the bid stacking, the 140 bids versus 50 offers, which in this tactical context was seen as potentially helping to push price down initially.
Okay.
Price then started moving pretty nicely in the direction of the short. As the trade progressed, they saw a lot of stacking on ask, appearing at lower levels, new offers showing up, creating potential new resistance or profit targets.
Resistance below.
Yeah. This prompted taking a partial fill, got filled on a half, on the short position, locking in some profit based on the developing order flow signals, indicating new potential resistance ahead.
Took some profit off the table.
Exactly. The description within the recording context was that it was a perfect trade, suggesting a successful outcome, even if only partially exited at that point.
So identify the zone on the chart, use the reconstructor tape for entry confirmation and large player activity, and then use the DOM ladder for observing immediate order stacking and tactical imbalances to help with exit timing or managing the trade as it unfolds. Noting that specific short-term imbalances can sometimes suggest a tactical push into limits.
That effectively captures the layers involved in this gold example. It's a dynamic process reacting to the fast-changing order flow at key chart zones.
Let's move to the third and final example discussed, another gold trade, a reversal or stop squeeze trade from a recording on May 20th. What was the overall market context leading into this setup? What was happening?
Okay, this was described as a market that had been very bearish, moving down significantly overnight and in the early part of the session, really selling off.
Very bearish, got it.
However, the price action then started to show signs of a potential shift. It formed a sort of a double bottom near an important older low from previous sessions.
A base forming?
Kind of.
Yeah.
And crucially, it then made a higher high relative to the initial session low.
Higher high. Okay, that's key.
Right. This sequence, potential base near prior support, followed by a higher high, suggested that despite the strong prior bearishness, underlying sentiment might be shifting towards a potential reversal.
So a potential shift in sentiment visible on the chart structure, moving from lower lows and lower highs to potentially higher lows and higher highs. Why choose to trade the upside, long, in a market that had been so heavily bearish? Seems risky.
It does, but the source explained that trading the upside was deemed much more beneficial from a risk-reward perspective than trying to short near that potentially tricky low area.
Why is that?
Well, the double bottom wasn't perfectly formed, and trying to short near a potential reversal point, especially one close to an older important low, would have required placing a large uncertain stop loss high above resistance. Trading the potential reversal offered a clearer target zone higher up and potentially better risk reward if the reversal played out.
Okay, so the chart structure, combined with a risk assessment of potential trade directions, pointed to focusing on the long side. What was the specific entry logic for this long trade? Where did they get in?
The long trade specifically targeted the protective stop orders from bears traders who'd gone short during the significant overnight downtrend and the early session sell-off.
Going after the bear stops.
Exactly. Their protective stop-loss orders were highly likely to be placed just above the distinct higher high that formed earlier in that session, as this was a clear level of recent resistance.
Makes sense.
The entry for the long trade was specifically placed as a buy-stop order 2 ticks above this previous higher high, intentionally aiming to trigger into that expected large cluster of stop orders resting there.
This sounds like a textbook short squeeze or bear squeeze setup.
That's exactly what is described as a bear squeeze or short squeeze. As price rises towards that cluster of bear stop orders, bears who are short start to get nervous.
Uh-oh.
If they don't want to cover, they might try to average down their position by selling more, adding more limit sell orders. Limit orders, people try to protect, just above the current price or at the previous high.
They add to their shorts.
Yeah, their reasoning is that if the market is rejected at that high, they'll improve their average entry price, and if they're wrong and it breaks through, they'll be stopped out just like the others, but maybe with a slightly better average.
So as price approaches the bear stop cluster and resistance, the previous higher highs, you expect to see bears adding limit sell orders, creating visible resistance on the ladder, even as buyers are trying to push price up.
Yes, and as price approaches this critical level, you look for specific order flow confirmation that the buying pressure is strong enough to overwhelm that resistance and trigger the stops.
What confirmation are you looking for?
Initially, you want to see a lot of struggle before we get there. Significant volume, lots of buy and sell orders, trading on time and sales, indicating that the level is very important and attracting participation from both sides.
You want to see a fight.
Exactly.
Yeah.
You don't want to see an empty state or pathetic price action slowly drifting up. You want to see a battle brewing.
And then as you get right to the level, what signals matter then?
As we get closer and closer, you want to see more buy orders on the reconstructor tape, those large green block orders confirming aggressive large player buying.
The big buyers again.
And more imbalance on the ladder specifically. More, in this case, offers than the bids on the ladder dome at that level.
More offers than bids, showing the resistance.
Right. This imbalance shows the bear's defensive limit selling, and the aggressive buy orders on the tape confirm that buyers are hitting and absorbing those offers with conviction, indicating the momentum is there to potentially trigger the stop cluster resting just above the level.
And what was the outcome of this specific gold trade attempt described in the May 20th recording? Did the squeeze happen?
Oh, yeah. The buy-stop order got filled right on top of it, triggered precisely by the surge of orders hitting the level.
Got filled right in the action.
Immediately upon getting filled, they observed a lot of green block orders on the tape, confirming the aggressive buying surge and big imbalance on the ladder. The move that followed was described as so fast, so violent, a huge move upward as the bear stops were triggered and new buyers potentially piled in.
Wow. That sounds like the stop hunt, fueled by large player participation and confirmed by order flow, worked exactly as anticipated.
Yes, pretty much textbook according to the description. The source noted that while simulating this with a slower feed might have shown a stop out due to processing delay.
Ah, simulation lag.
Yeah. But in live trading, with orders stacked directly on the exchange via a good broker, you would likely be safe and winning in trades like that, likely getting filled precisely where those stops were hit with minimal slippage, benefiting from the ensuing violent move.
That's a key point about execution speed.
Definitely. They reinforced that rolling back the recording confirmed how much big, large, huge block buy orders we've seen there, how the ladder dome reacted with huge imbalance at the level, and how that imbalance changed after the breakout, all confirming the strong order flow behind the violent move.
These three examples really bring the concepts to life and show how they can be applied in real-world trading scenarios in thin markets. It seems like the pattern is identify the high probability zones on the chart, the swing highs, swing lows, areas where stops are likely resting, and then using very specific fast-acting order flow tools like the reconstructor tape and total ladder imbalance at those precise moments to confirm that the large players are indeed stepping in with conviction to push price through those levels.
Exactly. It's not about predicting the future with certainty. It's about identifying where the conditions are ripe for a significant move driven by large participants, and then using order flow to confirm that the catalysts, the aggressive orders, and the willingness to absorb resistance are present right now. It's a synthesis of price action telling you where to look, and order flow showing you what's happening there in real time.
This all reinforces the core challenge you mentioned at the start. To succeed consistently in trading these fast, thin markets, you have to be really, really fast and proficient in processing information because things change dramatically within 1 second.
Oh yeah, dramatically.
There's no time for hesitation or deep analytical calculations?
None. You can't.
Yeah.
Look at many different things, trying to calculate numbers on the ladder manually. The traditional methods of detailed, slow ladder analysis are simply too slow for this environment.
Just can't keep up.
Nope. You need to be able to react really fast to visual and auditory cues.
And this is where the tools come in, specifically mentioned by the source. Tools like jigsaw trading are highlighted as being specifically designed to help with this rapid information processing, offering a really nice opportunity to get this information fast in a nice way.
Right. Features like the nice reconstructed tapes, which aggregate split orders to show you large participation, and features like voice warning alerts for large orders or significant imbalances are specifically mentioned.
Voice alerts, okay.
These tools help present that crucial order flow information, the presence and direction of large orders, and significant imbalances at key levels in a way that allows for quick, almost intuitive reaction rather than requiring lengthy analytical processing that the market speed simply doesn't allow for.
So it's less about deep, complex, tick-by-tick analysis of every single order and more about identifying the key points of conflict on the chart and having tools that rapidly, almost instantly, confirm the presence and direction of large player participation at those precise moments.
Yes.
Allowing you to jump in with conviction when the signals align.
That's the fundamental shift in mindset and approach required for these markets. It's about spotting the telltale footsteps of the large participants, those who truly move the market, at the critical junctures identified by price action, and being ready to act instantly when those specific high-conviction signals align.
Well, that's been a fascinating deep dive into the unique and challenging world of thin markets. We've covered how their low liquidity, fast moves, and large rotations fundamentally set them apart from thicker markets, demanding a different trading approach.
And we've highlighted why traditional, slower ladder reading is often difficult and less reliable,
Yeah.
pushing us towards alternative order flow signals designed for speed and detecting large players.
Yeah.
We focus on the key signals that do matter, analyzing accumulated executed order flow after the fact at important price levels to confirm their significance, watching for huge imbalances on the ladder as price approaches those chart-defined battlegrounds to gauge the intensity of resistance or support.
Right.
And critically, using tools like the reconstructor tape in real time to confirm large player activity and conviction behind a potential move, seeing those aggregated block orders appear.
Crucially, we've seen why using the chart for price action, focusing on the current session structure, identifying key swing highs-lows, areas of rejection and consolidation, is indispensable. It shows you where the potential order flow surges and stop clusters are likely to occur, allowing you to filter out the noise and focus your order flow analysis on the high-probability locations.
It all boils down to recognizing that success in these fast-moving, thin markets isn't about being the best at complex numerical analysis under pressure, but about developing the proficiency for rapid, informed reaction based on a specific set of visual and auditory order flow cues.
Right, reaction time.
Yeah. These cues are most powerful when they align with key price action levels where large participants are known to operate and where pools of liquidity, like stop orders, are likely resting.
As we wrap up this deep dive, consider this. How does the very nature of thin markets, demanding instant interpretation of order flow at volatile turning points rather than leisurely analysis, fundamentally change the required trading mindset?
That's a great question.
Does understanding the footsteps of order flow, the aggregated actions of large players at these violent turning points, give you a new perspective on where the real forces in the market are acting, often triggered by dynamics far removed from the visible surface of a static price ladder? Something to think about as you continue your own learning journey navigating the complexities of financial markets.